I've made a little bit less than $500,000 over the last 9 months day trading stocks. This is my personal Schwab brokerage account, and I'm going to show you how to use the only 2 indicators I have ever used in my trading career. And by the end of this video, you're going to learn how to set up these indicators on your charts, how I make well over $1,000 per day using these indicators in my trading. And my goal is to completely change your perspective of how simple trading truly is. This isn't going to be a long video, maybe 15 to 20 minutes long, but I'm going to teach you as much as I possibly can in those 15 to 20 minutes to permanently change your trading forever. So make sure you watch until the end of this video, because if you do, it could be a game changer for you. You're gonna be able to implement everything that I'm teaching you in your trading, literally starting immediately. Let's hop right into the video. So step number 1, you're gonna go to indicators on your trading platform. Right now, I am on tradingview.com. Now, for my own personal day trading, I use Think or Swim. Now, you're going to see tons of different complicated looking indicators. You're going to see crazy names like the Shande Kroll Stop. You're gonna see Elder Force Index. You're gonna see like Williams Alligator, and you're gonna be overwhelmed. You're gonna be confused. Which one do you actually use? And you're going to want to actually ignore all of these fancy sounding indicators. And your goal is to keep things simple. So what you're gonna do is look up moving average, okay? You're gonna look up moving average, and you're gonna see all these different types of moving averages. Now, what you wanna do is double click on simple. You're gonna click it once, and then you're gonna click it one more time. Once you do that, you're going to see these 2 moving averages pop up in the top left. And you wanna hover over one of them, and you wanna go to settings. And once you do that, all you need to change is, you wanna change the length of 9, change it to 20, and then press OK. Now go to the other one and do the same exact thing. Hover over it, go to settings, and from here, change the length to 9. And this time, you're gonna change it to 200. And voila, these are the only 2 indicators I have ever used in my trading. Now, I also use volume. I don't really consider that an indicator, and I'm gonna make a separate video on that, so make sure you subscribe to the channel to watch that video as well. But I've only ever used 2 simple moving averages. I think the simplest things in life are oftentimes the most brilliant. I have never used MACD, I've never used stochastics or VWAP or RSI or Elliott wave theory or Fibonacci. I keep it simple. And a lot of you guys are gonna watch this video and be like, oh my God, 2 simple moving averages? Like what? Like I thought you would be using all these complex tools. No, I don't use any fancy indicators. I keep it simple. And funny enough, these are 2 of the most powerful indicators you will ever use in your trading, and I'm about to show you why. So first, I'm gonna teach you how to use the 20 MA, and then I'm gonna teach you how to use the 200 MA, and I'm going to keep things as simple as humanly possible. But before I do that, I wanna emphasize that you should never be solely relying off of indicators. Indicators are meant to complement your trading. They should never drive your decision making in the markets. And this is one of the biggest mistakes that I see beginner traders make. They have like 3, 4, 5 different indicators on their charts. All of those indicators are fancy looking. Their charts look complicated. So the trader feels like they're doing something right, because everything looks complex, it looks sophisticated. And next thing you know, those indicators are all saying different things. And the trader doesn't know which indicator to actually follow. And that trader goes into what's called analysis paralysis, where one indicator is telling them to buy, another indicator saying it's bearish and to sell, another indicator saying there's no momentum and it's sideways, and then the trader doesn't know what to do. And they end up making the wrong decision, and they end up doubting their own judgment or doubting their own conviction. And that's exactly what you want to avoid. And that's why I like to keep things simple. I like to use 2 simple moving averages. You know, the reason I'm able to make money is because I keep it simple. And these moving averages complement my ability to read price action in the markets. Okay, so the first thing that you need to understand about the 20 MA is that it is the ultimate trend following tool in existence. And as a trader, I want to trade in the direction of the trend. I want to trade in the direction of where price is going. And in order for me to trade in the direction of price, I need to establish what the trend is. And the 20 MA helps us do that. So I want to see the 20 MA either trending higher or I want to see it trending lower. Now, obviously, if it's in an uptrend, I want to see it trending higher. If price is in a downtrend, I want to see it trending lower. Now, you want to ignore the 20 MA. And by the way, the 20 MA, like a moving average, it's just a line. That's all it is. It is just a line that finds the average price of the last 20 days. Now, if this was like the 100 period moving average, it would find the average price of the last 100 days. If it's the 200 MA, which I'm about to talk about in a few minutes, it's the average price of the last 200 days. So the 20 MA is kind of like a medium term moving average that I just love to use. It is incredibly powerful, as you're going to see in this video. Now, we want to see it trending. When the moving average, when the 20 MA is flat, that's when it loses its effectiveness. It's not useful for us. So we don't want to see flat moving averages. In fact, a flat 20 MA could suggest that that stock or that crypto or whatever you are trading actually lost momentum. If a stock or whatever has momentum, you're probably going to see either a rising 20 MA if it's an uptrend or a declining 20 MA if it's a downtrend. So that's a really easy way that you can immediately tell what the trend is or where the trend is going, whether the moving average is rising or declining, or whether it's flat, and when it's flat, it has no momentum and prices are sideways. Now, if it's a rising 20 MA, what we want to see is this moving average under price and trending higher, okay? And oftentimes during a bullish uptrend, you will see prices literally trade off of the 20 MA. Prices will literally retrace and consolidate into the 20 MA. And every time prices come close to or touch the 20 MA, that could present buying opportunities, okay? And we're about to look at a ton of examples, but that's the premise. The moving average is rising, it is under price, and it's an uptrend. And we see prices literally trade off of that moving average, where they will touch it and bounce, or consolidate into it and continue higher. Now, the same thing applies if it's a downtrend, except the moving average, we want to see it over price trending lower. So we get a move down, we retrace into the 20 MA. Move down, retrace into the 20 MA. Move down, retrace, move down, retrace. And every time we get that retracement, that gives us an opportunity to potentially go short. So using the 20 MA, it will allow us to essentially enter into established uptrends or established downtrends. And as a trader, I like to go in the direction of price. A lot of people tend to try to go for reversals. Why? Reversals and picking tops or bottoms is difficult, yet so many beginners kind of gravitate towards that strategy. It is far easier trading in the direction of the trend. So that's what I'm looking for. A rising 20 MA during an uptrend, and I'm looking for prices to trade off of the 20 MA. And the same thing applies in a downtrend, but the opposite. The 20 MA is overpriced trending lower, and every time we see a retracement or a consolidation into the declining 20 MA, that gives us an opportunity to go short. And remember, we don't want to see flat 20 MAs. A flat 20 MA suggests lack of momentum, and it suggests that prices are sideways. So here's a great example of exactly what I just talked about. This is the 20 MA, this thick blue line. And what do we have here? We have an uptrend. We have higher highs, higher lows on the charts, and you could see that the 20 MA is rising, it is underpriced, and look how well prices respect this 20 MA. Prices are using the 20 MA almost as support, where whenever we retrace or whenever we consolidate into that 20 MA, we bounce and we continue the uptrend. This is exactly what I am looking for. Rising 20 MA with an established uptrend. And same thing applies if it's a downtrend. This is the 20 MA right here. It's overpriced. It's trending lower. And you could see we have a consolidation into the declining 20 MA, drop. Consolidation into the 20 MA, drop, right? And look at this. It literally perfectly touched this 20 MA, and that's when we got the breakdown. We retraced, didn't quite touch the 20, kind of got close to it, another breakdown. And this is what I'm looking for. Established uptrends or downtrends. And I like to use the 20 MA as a location of where I'm looking to go long if it's an established uptrend, or I'm looking to go short if it's an established downtrend. Finally, we also use the 20 MA to measure what's called extension. Extension is the distance between price and the 20 period moving average. So you could actually use the 20 MA to measure how overbought a stock is. And I don't really like to use that word overbought. I like to use extended. So by looking at the distance between price and the 20 MA, I could tell whether I want to get in, or I could tell whether I even want to go for a reversal, where sometimes prices are so far away from the 20 period moving average that I know that it's going to revert back to the mean, and I'll actually go for a reversal setup. This also gives me information where I know I'm not going to go long up here because we're so far away from the 20 period moving average. It is way too extended. Finally, let's talk about the 200 period moving average, and this is actually even simpler. So what we're looking for is for a flat 200 period moving average. The 20 MA, we wanted that to be trending, whether it's uptrending or downtrending, and we don't want the 20 MA to be flat. It's the opposite for the 200. We want the 200 period simple moving average to be relatively flat. And the 200 MA could act as a ceiling for price whenever prices are trading below it. It could also act as a floor for prices whenever prices are trading above it. So what does that mean? Let's say you have a bunch of price action right here. This 200 MA could act as resistance for this price action, where a lot of time prices will go to the 200 and bounce from it, go to the 200 and bounce from it. So it could actually be a resistance area for prices if prices are below the 200. Now, the same exact thing applies if it's support, if prices are trading above it. Let's say you have a bunch of price action. This 200 MA can act as support for price, where prices will actually bounce from it. And it's literally like a floor for price action. Now, this setup is quite rare. However, I do want to mention it. Every now and then, you'll get what's called a squeeze play, where you have a flat 200 period moving average, and then you have a 20 period moving average that is rising and going through this 200. And what you'll sometimes notice is prices will actually oscillate between the two, where it's going to use the 200 as a ceiling, as resistance, and it's going to use this 20 MA as support, and they'll continue to oscillate and oscillate and oscillate and squeeze until the point where it can't squeeze anymore, and it's just going to break out. And these setups are quite rare. However, they're extremely powerful. So you want a flat 200 MA, rising 20 MA that's going through the moving average, and you want to see prices oscillate between the two until eventually they can't, there's no more room to oscillate, and then they break out. And this honestly works better for like swing trading. So I'd look at the daily or weekly time frame for this. If you're enjoying this video so far, I have hundreds of hours of free education online, not only on my YouTube channel, but I also have a free 10+ hour trading course that is genuinely better than most paid courses on the internet. You could find my free course in the description of this video and combine my free education in my course with everything that I teach also on my YouTube channel. And if you are someone who is a little bit more serious, you're looking to really become a full-time trader and you're looking for more hands-on mentorship, I do personally coach and scale traders from zero to making $5, $10, all the way up to $50,000 trading per month where I take you under my wing and you trade live with me every single day. So if you're looking for something a little bit more serious, you could apply for my mentorship in the description of this video. Alrighty, let's look at some fantastic examples on how you could apply the 20 and the 200 MA into your trading. And I'm going to give you my thought process on how I apply it in my own trading. And by the way, these are not like cherry-picked examples. These are all stocks that I was watching or that I traded this past week. Like this KDP, this is Keurig. This had an overnight gap down yesterday where it gapped from $35 and the next day it opened at $32.50. And notice how we gapped directly below the 200 and how we opened below all of this support. So I was going into yesterday with a bearish bias, and I actually really like gaps that open below the 200. But let's take a look at the 5-minute time frame. This is one of the main time frames that I use, and look at how well prices are respecting the 20 MA on the 5, especially as soon as the 20 MA starts to actually establish a downtrend. As soon as the 20 MA is trending lower, right here basically, notice how well prices are respecting the 20. So right here, this is a potential short opportunity directly under the base. Dropped, kind of based into the 5, not quite, dropped again. Look at this, consolidated directly into the 20 MA and the 5. Next day, we gap down a little bit and continue that downtrend. Now, this is the 5-minute. Let's look at the 2-minute, especially today. And this is going to be shocking, but look at this. Look at how well prices are respecting the 20 MA on the 2-minute. I mean, every time it hits the 20 MA here, here, right here, right here, right here. Every time it hits the 20 MA, and it ends up dropping. And you could have literally went short every time prices hit the 20. And it would have worked for this absolute beauty of a power downtrend. And this is why I use the 20 during established downtrends. Notice how the 20 MA is trending lower very, very strongly. If we look at the 15, it's basically the same thing. Where the 20 MA is trending lower. However, there's a little bit of distance between price and the 20 MA. So the 20 MA isn't being like fully respected on the 15-minute chart. From there, you go to the smaller time frames to find your entries. But unbelievable daily gap that led to a beautiful downtrend where you could use the 20 MA for your entries to capitalize on this trend. Let's look at the BNS. This is a random stock that popped up today. This is the Bank of Nova Scotia. And stemming back all the way from 2024, when this uptrend kind of reversed, you could see that we entered into a downtrend on this stock. And this is the daily time frame, by the way. Look at how well prices are respecting the 20 MA on this downtrend. The 20 MA is overpriced, trending lower. We drop, retrace into the 20. Drop, retrace into the 20. Here we actually gapped down like 8% and it gapped right into the 200 MA on the daily time frame. So this 200 MA acted as a floor for price. It acted as support for price. We gapped right into it, instantly got bought, then retraced into the 20, hit it perfectly, dropped. Again, hit it perfectly, dropped. And then right here, the trend reversed and we went into an uptrend. And you could see for yourself, look at how well prices are respecting the 20 MA. I mean, I don't even need to explain it. It's literally obvious and it's simple. That's exactly why I use the 20 and the 200 MA. Even here, we had a gap up today. Literally today, we gapped up 2% on a really bullish chart, really bullish trend on a nice gap up. Go to the 15-minute time frame to find a potential setup. And even on the 15, look at how well prices are respecting the 20. We have a nice rally. 4 red bar pullback, nice little buy setup here. We kind of move up a little bit right into the 20 and then we take off and make new highs. And this is why I use the 20 and the 200 on the intraday time frames and even on the larger time frames, because they're simple and they allow me to understand what the trend is. When I look at this chart, I know exactly what's going on. Established downtrend, then an established uptrend. And I know where I could potentially get into the trend using the 20-period moving average. Let's take a look at this RR, which had a really nice breakout the last couple days, but let's go back to 2024. And this is a really good example of a squeeze play where we have a rising 20-period moving average, flat 200-period moving average. You could see prices hit the 200, then hit the 20, then hit the 200, kind of oscillated back and forth. It's not a perfect example, but once it broke out, it really broke out. And this thing rallied like over 500%, which is insane. So that's a decent example of a squeeze play, but that's not even what I want to show you in this example. Look at how well the 200 MA is acting as support and as a floor for this stock. Like we hit the 200 here, instantly we bounce. Then we kind of chop around. We retest to 200, we bounce. Here we actually almost break down through the 200, that's instantly rejected. We move right back up. Again, we try to break through the 200, rejected. Again, right here, we try to break through the 200 to the downside, rejected. And then this time it led to a 62% move to the upside. And this is why I like to use the 200 MA. Whenever prices are above it, it acts as a floor, it acts as support. And by the way, this is the daily time frame. Let's look at a good example of using the 20 MA during the intraday time frame. So this stock had a very minor gap up. This was just a few days ago. It gapped up 2%, so it opened higher by 2%. It had a really nice green day. I'm seeing the 20 MA on the daily time frame is starting to trend higher. It's underpriced. So I went into this day with a bullish bias. And just take a look at this 5-minute time frame. Just beautiful uptrend, and it's beautifully respecting the 20 MA where we had a nice breakout here. We moved up, retraced to the 20, kind of chopped around, another move up, retraced to the 20, move up, retraced to the 20, move up, retraced to the 20. And it's just respecting the 20 MA almost perfectly. And every time it hit the 20, that was actually an opportunity to potentially go long. And just a beautiful uptrend with the 20 MA underpriced trending higher. Let's look at another example where we combine using the 200 MA on the daily time frame, and then we use the 20 MA on the intraday time frame. So this MAT gapped from like 2018, and the next day it opened 6% lower at around 1890. Notice how we gapped directly below the 200, literally directly below it. We didn't gap into it where it would act as support. We gapped right below it. And we also gapped underneath a lot of this support as well. So beautiful gap down. And from there, we go to the intraday time frames to find a potential setup. So off the 5 here, I mean, again, you could see how well prices are respecting the 20 MA. The best setup was right here, stop loss above basically. So this is the 5. Even if we look at the 2-minute, again, every time prices hit the 2-minute 20 MA, we get a move lower. We drop, retrace to the 20 MA and the 2, drop. Then right here, notice, check this out right here. We attempt to break above the 20. We attempt to kind of end this downtrend, break over the 20. That was rejected. Then we continue to base. The 20 acted as resistance, and boom, we got another breakdown. Again, right here, attempt to move past the 20, breakdown. Attempt to kind of go through the 20, breakdown. And you could see how well prices respect the 20 MA during this established downtrend on multiple time frames. Even if we look at the 15, right? It's usually better to look at the smaller time frames for your entries into these day trades, but even on the 15, 20 MA is overpriced, trending lower, confirming that bearish downtrend. This is Coinbase from a few weeks ago. We have a rising 20 MA under price. We have a consolidation into that rising 20 MA. 200 MA is directly above. We gap above the 200, around 12% to the upside. Gap above the 200, triggering this base breakout on the daily time frame. 20 MA is under price. You go to the 15-minute time frame for a potential setup, and beautiful uptrend. Let's look at the 5. And you could see, look at that 5, how well prices are respecting the 20 MA. We have that initial move up, we consolidate directly into the 20, break out over the base, nice move up, retracement into the 20. Look at how well it's respecting the 20, and then we have another leg higher. We retrace, another move up. So you could see how well prices respect the 20 MA, and this is exactly why I use it on multiple time frames. Let's finish off this video by looking at the S&P 500, the SPY. So this bottomed out in April, and since then we have been up only. And during this uptrend, what do you know? Look at how well prices are respecting the 20 MA, even on the SPY. So we have a nice move up, retrace into the 20. Nice move up. Here we consolidate into it. Then we have another breakout from the 20. We try to retest it on this tail. Instantly, we move up. Here, we actually broke under the 20. This was a few weeks ago. We broke under the 20, instantly rejected, have another nice move higher. Here we have a retracement, nice buy setup into the 20, boom. And now it looks like the SPY wants to continue higher. We could even look at like crypto. Let's take Ethereum. Look at how well Ethereum is respecting the 20 MA over the last few months. We have a rising 20 MA under price. Here it kind of broke below, instantly rejected, and we had a nice move higher. We retraced right into the 20, literally hit the 20, instantly we popped. Another red bar, hit the 20, boom. The next day we have a nice green bar. This was on the Jackson Hole, Jerome Powell speech. Then we retrace, hit the 20, boom. Today, literally another green bar. Even if you look back just a few months ago, I bought a shit ton of Ethereum right here because I saw that the 20 MA started to transition higher. It's curling up. The 20 MA is underpriced, trending higher. We have a nice move up, base into the 20. This was a beautiful breakout. And what do you know? It hit target at the 200. So the 200 acted as a ceiling for Ethereum, where it hit the 200, retraced, hit the 200, retraced, hit the 200, retraced, hit the 200, retraced. Here we broke through. We kind of had a fake out and then a fake out to the downside. 20 MA is flat, so it's not that useful. And then as soon as the 20 MA begins rising and trending under price, that's when Ethereum starts respecting it and it resumed the uptrend. And I'm still expecting much higher prices for Ethereum. And that is exactly why I use the 20 and the 200 MA for every single one of my charts that I look at. I like to keep it simple, guys. All I use are two moving averages, the 20 and the 200. And by keeping it simple, that's what allows me to make money. So hopefully this could be transformative for your trading, and hopefully this will help you keep it simple. So make sure you subscribe to the channel if you enjoyed this video. Leave a comment if you found it valuable. Leave a like. That's going to help the YouTube algorithm. And hopefully you learned a lot, and I will see you on the next video. Thank you very much.